So we spoke to Jen Nason, who's the global chairman of investment banking at a place called JP Morgan. So you would think that potentially all the craziness in markets would potentially delay people from IPOing. And actually, obviously they're all watching it day to day, but the real takeaway from Nason, she tells me, is that they're accelerating plans to go public. If you want to go public in 2019, then the idea is that it's better to go in the first half of 2019 rather than the back half. When, as we get closer to the end of this economic cycle, you can really start to see the markets get even less accommodating.
Is there pressure from private investors to liquidate to be able to pull the cash from what has been a very illiquid investment? I mean, big names like Fidelity, for instance, might see some pressure. I don't know.
Absolutely. I mean, I think Uber, Lyft, if you're those guys, you want to basically give your investors, you want to give your employees an exit at a decent valuation. And is that going to happen at the tail end of this economic cycle, this business cycle, or the beginning of an all-new cycle when valuations would probably be lower?
So they're concerned that all of a sudden there won't be any way to go public if the markets get so bad.
Right.
That they'll be stuck as these private companies trying to get into the public markets and the pricing isn't there.
That's the danger, that you have a window to go public, and that window is getting tighter and tighter.
In terms of when they do go public, in order to appeal more to investors who may be less willing to take on risk in this market environment, do they change how many shares, for instance, they sell, or the corporate structure in terms of Class A and Class B shares, et cetera?
I mean, and I'm no expert on this.
Sure.
I don't think you want two classes of shares. I think that's something that's kind of a red flag.
Investors don't want. I
don't think
companies want it.
Companies perhaps do.
Right.
I don't know if investors do. I do think that that they're not going to be listing more than 10 or 20% of the entire float, right? So it's a part of the company. You have valuations that are 120 billion in the case of Uber. These are sky-high valuations.
But you pair that with what's happened at Snapchat. I mean, to look at the shares below $5, concerns about the CEO and a structure that is not shareholder-friendly at all.
Sure. So what you have here is you don't really know who the winners and losers are until a little bit of distance, right? If you could invest in the IPO of Google or Netflix, you would have done that, right? You don't really know who the winner is going to be until a little bit time later.